I have a client that will most likely never pay taxes on any of the money in their IRA. And in this video, I'm going to explain how that's the case. Hey everyone, I'm Andrew. I'm the owner of Lever Wealth Management, which is the financial advisor for people who scare financial advisors. And I've spent the last several years helping ultra high net worth and high net worth investors with their complex financial lives. And what I do is I take the learnings from those situations and I give them to you so that you can apply them to your own situation. The story I'm going to get into today, I think, is a good illustration of how we can dynamically change our income tax brackets over time. I had a client who had some carry forward ordinary losses that has done Roth conversions the last several years. And because of the loss carry forwards, they've been able to not pay taxes as they've converted their IRA. Now, that's a very specific situation. However, retirees, especially those who retire, let's say at 60, now that required minimum distributions are not going to be required until age 75, you have around a 15-year gap that you can play with your income tax rates and make sure you are being judicious in how you pay your tax. And one way to do that is you have a standard deduction if you're married filing jointly or if you're single. But if you're married filing jointly and you don't have a bunch of taxable assets, you can systematically convert IRAs to Roth at a 0% tax rate. Furthermore, you can systematically convert IRAs to Roth at a 0% tax rate. And if you do have some taxable funds, you could tax gain harvest at a 0% federal rate each year to increase your tax basis over time. Well, depending on how big your IRA is, that could be a meaningful or not a meaningful strategy. But if we assume for a second that you have $1 million, that's 3% a year if you're married filing jointly that you could move over tax-free. And that's also assuming you're not itemizing, right? Perhaps you do some bunching of donations and you increase it, and then you subsequently do a larger conversion. Perhaps you have some large medical expenses one year. You get the point that I'm working towards here. Well, the client I had some loss carry forwards, but we didn't convert all of the IRA. And this is where I see many advisors go down a path that I don't necessarily agree with. I think they're well-meaning, but I diverge in the sense of, for many people, success is not converting the whole IRA to a Roth. If there is any charitable intent, at age 70 and a half, you can start doing what's called the QCD, your qualified charitable distribution. And the good thing about that is, since it's getting made directly out to a charity, they don't pay income taxes on it because they're a not-for-profit entity, and you don't pay taxes on it. It never hits your tax return because the money's not being distributed to you first, right? Let's say I'm a person who knows I'm going to give $10,000 a year. What you do if you retire at 60 is you bunch donations with the donor advised fund so that you can choose the best years to get your donations in, subject to the adjusted gross income caps. But you leave enough money in the IRA that there's going to be a required minimum distribution of $10,000 each year. In the way the RMD is structured, because it's based on actuarial tables, it ends up being a bit of an inflation adjustment as well to that figure, which most people want. I may leave $250,000 in an IRA to make sure I am right-sizing my required minimum distribution, and I just know that's all going to go to charity. Because, just like with this person over here, yes, there are some loss carry forwards, but if I'm going to be earning an income in the meantime, I want to use that to offset my active income. And I don't want to convert IRA dollars that I might not need to ever pay tax on anyways. You need to decide for yourself, how likely is it I want to give to charity? What's the frequency of that, and what's the dollar amount? What I can say is that most people, once they get into retirement and they've had several years of spending and they understand, I'm going to make it, I'm going to have enough money, that's when they really start to ratchet up their charitable goals. And with that, however, if you're a person that thinks, that could be a goal of mine, I may want to give to charity in the future, you should put a much higher discount rate on what you're willing to convert today. Because what I've practically seen from those who do have large IRA balances and who are able to make it in retirement is once they get past the first couple of years where they're questioning, is the modeling right? That's when they start to go, I think I might just want to start being more philanthropic. And what we don't want to do is over convert our IRA at a 24% tax rate, to give an example, when we could just leave some amount in there, right? You leave $1 million in there and you give 40,000 away each year, or you give half of it away. And it's one of those things where it's important to be directionally accurate with it, but the optionality of leaving a little excess today to possibly save yourself all of the taxes in the future, like my client, could be very helpful and worthwhile. If anything I said didn't make sense or you have a specific question, go to leverwealthmanagement.com/ask, where I answer all of your questions directly. And until next time, thanks y'all.